for major banking crises since 1873. For different triggers. The same four-stage sequence every time. This is an archive of documented events. It is not a forecast, not investment advice, it is the historical record. Chapter 1. The Panic of 1873. The US and European economies had expanded rapidly after the American Civil War. Railroad construction was the engine. Credit was the fuel. In September 1873, J. Cook and Company, the largest bank in the United States, failed. It had overextended on railroad bonds. Bank run spread within days. The New York Stock Exchange closed for 10 days, the first closure in its history. 23 other financial firms failed within the week. The US entered a contraction that lasted 5 years. Unemployment rose. The period was called the Long Depression. Credit did not recover to prior levels for nearly a decade. Chapter 2. The Panic of 1907. 34 years later, in October 1907, the Knickerbocker Trust Company in New York suspended payments after a failed attempt to corner the copper market. The run spread to other trust companies within hours. The United States had no central bank. There was no institutional lender of last resort. J.P. Morgan, then in his 70s, personally organized a private consortium of banks to inject liquidity. He physically locked bankers in his library until they committed funds. The crisis was contained within weeks, but only because one private citizen had the capital and authority to act as a central bank. Congress recognized the structural gap. The Federal Reserve was established in 1913, directly in response to the 1907 panic. Chapter 3. The Great Depression Bank Runs, 1930 to 1933. The 1929 stock crash triggered credit contraction. By 1930, depositor confidence had begun to fracture. Between 1930 and 1933, over 9,000 US banks failed. Bank runs became self-fulfilling, each failure accelerated the next. The Federal Reserve, newly established, tightened monetary policy during the contraction, the opposite of what the situation required. Milton Friedman later called it the Great Contraction. The bank holiday of March 1933, declared by President Roosevelt, suspended all banking for 4 days and reset depositor confidence. The FDIC was created the same year. Chapter 4. The Global Financial Crisis, 2008. Credit had expanded through structured mortgage products, CDOs, MBS, that distributed risk across institutions globally. The underlying assumption was that US house prices could not fall nationally. In September 2008, Lehman Brothers filed for bankruptcy. Interbank lending froze within hours. Money market funds broke the buck. The Federal Reserve and Treasury intervened with emergency liquidity, TORP, commercial paper facilities, backstops for money market funds. The intervention was the largest since the 1930s. The contraction was severe, global trade fell by 12% in 2009, but no major developed economy's banking system collapsed entirely. Chapter 5. The four-stage pattern. Across all four crises, spanning 135 years, the documented sequence is consistent. Stage 1, credit expansion, often concentrated in a single asset class or sector, reaches a level where a single failure can trigger contagion. Stage 2, a trigger event. A firm failure, a run, a price collapse. The trigger is rarely the cause, the expansion was the cause. Stage 3, contagion. Confidence withdrawals spread across institutions regardless of their individual solvency. The run is rational for each individual actor. Stage 4, lender of last resort resolution. In each case, the crisis ended only when an institution with sufficient scale, Morgan in 1907, the Fed in 1933, and 2008, acted as backstop. The archive runs from 1873 to 2008. The shape has not changed.